Hello and welcome to this week's episode of Nucleus Investment Insights. Today's episode is called An Investor's Guide to Third Quarter Earnings. The overall earnings trend showed a downgrade in earnings forecasts, signaling a cautious approach by many companies. However, in amongst this, the Magnificent Seven stocks bucked the trend again. These stocks have not only defied the broader market sentiment, but have also showcased remarkable resilience and growth potential. Today, we will dissect the earnings reports and try to discern whether the surprisingly optimistic outlook for 2024 is justified, considering the immediate uncertainties of high inflation, high interest rates, and deteriorating economic conditions. Just a reminder, the information in this podcast is general advice only and does not take into account your personal financial situation. If you do want to discuss your personal financial situation, you can book a call with me or one of the advice team at nucleuswealth.com/contact. Today, as always, we have Nucleus Wealth's Chief Investment Officer, co-founder, and star of the show, Damien Klassen. Welcome back for another week.
Thanks, Sam.
My name's Sam Kerr. I'm the head of advice at Nucleus Wealth. The themes discussed in this podcast are a reflection of our thinking, which we implement across all our active portfolios. You can find out more about our offering in the description notes below. This show is recorded live every Thursday at 12:30 Australian Eastern Standard Time. So jump onto the Nucleus Wealth YouTube channel and you can ask any questions that come to mind, and we'll do our best to answer them during the show. The podcast is also available on all other major podcast platforms, so feel free to have a listen there if you prefer. Also, until the end of the year, we still are offering a free no obligation super review. So we'll give you clarity on how you're invested, as that's the most important thing. Have a deep dive into the fees that you're paying, make sure you're not paying too much, and also make sure you're aware of all the tax saving strategies on offer and the rules of the game. So you can book in for one of those with myself or one of the advice team at nucleuswealth.com/contact. So those are the formalities out of the way. So Damo, over to you to get the ball rolling.
Yeah, thanks, Sam. So it's going to be a relatively quick one today. I just wanted to have a quick run through this third quarter earnings. So, we've spoken in the about these next couple of reporting seasons being pretty crucial in terms of trying to work out what's going on. So we've had a couple of the first quarter and the second quarter were both sort of -5-ish in terms of profits down. Third quarter's come in much better than that, but we've sort of flipped around and seen pretty big downgrades to the fourth quarter, and also the third quarter is largely about a couple of individual stocks. And so I sort of wanted to have a bit of a run through what the stocks are, what sectors are working, what sectors aren't working, and then discuss how we're looking to sort of make some changes going forward into this. So I thought I might start actually not completely off topic, but slightly off topic in terms of the factors that are actually working. So in terms of what are the so with it, when you're doing investing, there's certain types of themes that tend to have good runs and bad runs. So for example, I've got a slide up sort of showing both the US and Europe across some of these style factors. So if I picked one, for example, size. So size is one where it's the theory is that small cap stocks will perform better. Now, this theory's got lots of adherents and a number of people against it as well. But over the last year, in particular in the US, size has been one of the worst indicators, and largely because that's the Magnificent Seven has been the stocks that have really driven performance. That hasn't been the case in Europe though, certainly in recent months. But not as much as the case in Europe. Size over the whole year has been quite a negative factor, but it's so you've been better off to be in the large cap stocks rather than small stocks. Low volatility stocks have done really well. Price momentum actually within the US has been one of those ones that's been probably one of the best performers for the year. So and that sort of keeps coming back to this theme of the Magnificent Seven. So the stocks, that sort of big seven stocks that are really driving performance have then also flowed on to you've seen the stocks that are going up keep going up, and the stocks that are going down keep going down. Has been very much the theme in the US in particular. Not as much in Europe. Europe's been a lot more month to month, a lot of chopping and changing. The one thing that has sort of been pretty consistent across both of them is valuation. So stocks that are cheaper have done worse, and that sort of sounds, sometimes it sounds I guess paradoxical. Is like, oh well, I should be buying, I should be able to buy cheap stocks, and that should be the best way to get performance. The problem with buying stocks just on a cheapness basis is that a lot of the time stocks are cheap for a reason. And what tends to happen is when you buy cheap stocks, you're buying the lowest quality stocks, the stocks that are at most at risk in terms of margin contraction. They're the companies that don't really have control over their own profitability. So what tends to happen is those stocks trade on quite low multiples because the earnings are so volatile. Whereas other stocks that are where you get much more steady earnings, you can price them on a higher level. So, for example, if we're looking, say, at the semiconductor space, you might find a stock like the complete metal blank, stuff with a letter M. Anyway, so you find stocks with volatile earnings, and they might trade on 5 to 10 times those earnings because you just don't know whether those earnings are going to be around next year or not. Micron is the stock I was thinking of. Sorry, Micron is a chip maker, and they go through these big cycles, and so you tend to find a lot of times it just looks really cheap. Whereas other stocks like an Nvidia, for example, will often look really expensive, but the earnings are much steadier and just keep climbing, and you don't go through these massive swings in terms of profits. So just buying a stock on valuation alone is for me is not a strategy I want to perform. I always want a second leg to it, saying, well, I'm buying stocks on valuation, but I need to know whether it's got growth or whether it's got quality behind it. And think of it the way you might think about buying stuff yourself. So if you're going to buy, for example, a car, you're probably not going to buy the cheapest possible car, and end up with a a car for a Russian car from 20 years ago that's going to break down every 5 minutes, but it was really cheap. You're going to go, well, there's a certain level of quality I need to buy price isn't the only measure. I need to actually get a level of quality for that price and try and get a trade off. So yeah. So with that, I guess what I'm trying to point to here is that what we're looking at is stocks with low volatility have really been performing well, and stocks with that price momentum in the US. Then when we look at what's been going in terms of earnings forecast, now I put this chart up not because I'm actually not quite so sure about not quite sure about the actual conclusions you get from this chart. I think this one's a little bit misleading. So what it is this is the US what they call the net earnings revisions index. So basically, if you look forward 12 months at what you're expecting earnings to be, is saying, is that going up or down? And what you generally find is when that's going up, stocks will generally go up as well. And when they're going down, as we saw last year, so you can see for 2020 and 2021, it was pretty firmly going up. For 2022, it was pretty firmly falling. And so you found stocks falling for that time frame. We've basically got it relatively neutral at the moment. And so not really going anywhere. Now that's it's a little weird in that we've got sort of two factors that are affecting this, and there's this sort of ongoing optimism that's sort of baked in terms of we have like a bad quarter of earnings, and then everyone's expecting earnings to bounce back next year, and then everyone just sort of pushes it out by one more quarter and goes, okay, but at the start of the year it's like, well, the first quarter was bad, but everything will be fine by the third quarter. And then the second quarter is bad as well. And it's like, oh, well, everything will be fine by the fourth quarter. And then now we've had a bad third quarter and the fourth quarter is coming down. It's like, oh, well, everything will be better by Q1 next year. And so there's this sort of inherent optimism sort of that's been that's sort of overlaying these numbers. And it's probably better expressed in this chart that I've got, the next chart I've got, which is basically showing a blue line, which is the 12-month forward earnings expectations. And again, I'm using the US. It's pretty similar for the global stuff, which I'll show you in a minute. But so what we're looking at there is that blue line's been rising for the last 6 or 9 months. But the reason why it's been rising So you can see that we've got 2023 and 2024 numbers. And so the blue line is basically a weighted average of the two. So a year ago, it was almost all 2023 numbers and no 2024 numbers. And then as the time goes forward, you get like a little bit more of 2024 and a little bit less of 2023. Now, the 2024 numbers are very optimistic. And so what you've been seeing is downgrades to both series, but because the downgrades to 2024 haven't happened that much, the line's been rising. So you've only seen some mild downgrades to 2024. And so the line's been rising not because actual results have been good, but because the forecast results, that period, it keeps getting closer and closer as to when all the good news is going to suddenly start kicking in. I've got another chart that sort of just shows those as well. Actually, it's probably better to I might jump to the earning upgrades and downgrades. So this is what I've spoken about a few times on this, is that what tends to happen is analysts have this whole thing about saying, when you look out a year, they sort of go, earnings will be about 10%. And that's where, if you look at this chart, every single year, that's roughly where earnings start. And then they break one way or the other. So for most of the sort of 2000s, early 2010s, they started at 10% and then sort of went sideways for a bit and then dropped back to sort of 5% or 0. We've had basically two fantastic years within that. 2018, when they started at 10% and then went to sort of over 20, and that was the Trump tax cuts. And then 2021, which was the bounce back year from COVID, from the terrible 2020 numbers. 2023 did exactly the same thing. Started at 10, ended up at 0. And then the question is whether 2024 is going to hold firm and at this sort of 12% growth rate that's factored in at the moment, or whether that's actually going to break down as well. And our expectation is that number will come down by sort of 10%-ish once we start to get closer. And we are starting to see signs of that. But within the sectors, there's certainly some pretty good sectors, and Q3 results were pretty good. I'll just go one more graph on this, Sam, and then I'll jump back to you. So I've got up here, this is the quarterly numbers. And so you can see, and again, this is just for the US. So the world numbers sort of were similar again, but so we saw that Q1 came in at sort of -3%, Q2 came in at -6%. Now Q3 is looking like it's going to be about 3% growth. And that's jumped up from 0. So it's actually been quite a positive increase in terms of that. It's almost all been that Magnificent 7 in terms of their earnings. But at the same time, we've actually seen some really meaningful downgrades to Q4. So that's why the numbers for the full year haven't changed, because what's been happening is surprisingly good results for a very small cohort of very large stocks. But at the same time, some quite significant downgrades to future earnings, the near-term future earnings. Sort of 2024 numbers are still sunshine and roses. So I might head back to you, Sam.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show. Just one more quick thing. We just want to ask you for a simple favor. We want to spread the message about transparency, innovation, and integrity in investing. At Nucleus Wealth, we live and breathe these values. We would love it if you can help us spread that message, and subscribing to our channel will help us do that. We would be most grateful if you can hit the like and subscribe button now.
Right. So if we look at that, so I'm gonna focus in on this third quarter earnings that we've just seen, and I've got one chart up on the left which is showing by region, but I've broken out that sort of big seven as to what the earnings forecast was 3 months ago. That's the chart on the right, and then the chart on the left is where it is at today. So what we've seen within that is, so 3 months ago we were looking at basically a 3% downgrade to, the earnings would be 3% lower than what they were the prior year. Now we're looking at 3% higher. And where's that come from? Well, actually, most of it come from better result from the big tech. That's sort of about 2% improvement there. And most of the rest of it has actually come from Japan. So Japan's sort of another 2% from Japan. Meanwhile, we've actually seen that most of the rest of the US 7, we have seen some improvement in that as well. Sorry. So it's certainly been a turnaround, but still sort of loss making within that, with still sort of earnings down within those numbers. A lot of that, and we'll move on to that in a second. A lot of that is smaller losses for a lot of the loss making companies. So I'll run through the tech side, but Japan is actually a good example where SoftBank, one of the sort of more technology or sort of more investing in sort of startup firms and sort of technology disruptors, went from making a huge loss last year to a smaller loss, and so that type of thing looks quite good in terms of the growth rate, but it's sort of driven by lower losses rather than some companies sort of particularly surprising at the upside. Then if we look at Q4, which is the so then if we look at the Q4 earnings, that's where we've seen those big downgrades. So we've seen that the big tech companies have got slightly better. So they were going to add 4% growth to the entire market. Now keeping in mind that the big tech companies aren't the whole entire market, so that they might have been adding, the companies themselves are adding sort of 20% growth and 25% growth. But that, because they're how big they are in the index, that sort of adds 4% to overall world growth, and that's closer now to 5%. But we've seen downgrades from a whole raft of other companies that sort of led to, and particularly in the US, sort of companies outside those big seven, we've seen a whole bunch of downgrades, which has led to that those final numbers. The thing is, though, if we look at 2024 numbers, the first quarter has now started to fall. So analyst forecasts for the first quarter are come back to, they were sort of 5 or 6%. Now they've come back to 3 or 4%. Most of it's sort of driven again by that US big tech. But then the numbers for the entire year are still pretty positive. So the question is, we've sort of had three bad quarters of earnings for every company except for the big seven. Pretty much every company except for the big seven. Now, fourth quarter earnings have been downgraded a lot. First quarter next year earnings have been downgraded a reasonable amount, but it's still got some great growth forecasts for the second half of the year. And it's hard for me to find reasons behind that. What tends to, within company by company, as you go through the forecasts and the expectations, the best or the most likely type of commentary you get around it is largely around the bit where people are saying, okay, earnings were bad last quarter, or they're bad this quarter, they'll probably be bad next quarter. They might get a little bit better by first quarter next year, and then hopefully by the end of next year we'll be growing at 10% again. And so without a lot of reasoning behind it, with more about saying, things have been bad, we're hoping things will get better, as opposed to other times where you can really see within analyst numbers that they're talking about stronger consumers or better action on costs or whatever it is. I also note there's a lot of companies that where the forecasts, or certainly the commentary around the forecast, tends to talk about falling costs and managing to keep their sales up. So it's this idea that, for example, transport costs shot up 10 times in the cost of, say, transporting a container from China to the US, and now they've fallen back down to fallen 90% back down to sort of more normal levels, and the commentaries you get around companies are saying, oh, my transport costs went up. I then jacked up my prices and I managed to expand my margins. Now my transport costs have fallen, but I'm going to manage to keep on holding up my prices. Now, and it's sort of like that commentary from so many companies that they're saying effectively the same thing. Everyone else's sales is going to fall because my cost is somebody else's sales. Everyone else's sales is going to fall, but my sales are going to stay steady, and so therefore I'm going to expand my margins and make all this great profitability. Now, it will be true for some companies, but by definition, it can't be true for all companies. So that's certainly where we're looking. We're looking quite looking quite deeply at which companies and which sectors do we think can hold on to those price rises, and which ones are going to just are going to see the prices fall back again, like the transport sector saw. So I might go to you, Sam.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now, direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
The next one I want to show. So what I want to do now is just dig into some of the actual companies, and then we'll wind it up and sort of talk about some of the learnings that I think we're getting from this reporting season. I've got some charts up that are a little bit different. What they're showing is starting at 100, where on the chart on the left, where was earnings per share for the top 1,000 stocks. So start at 100. You add on the Magnificent Seven, and this is for third quarter, and that would have taken you to almost 5% more growth. And then you add on consumer companies, some defensives, some finance companies, and you're up to over 10% growth. And then we see all the sectors that detracted, and a lot of it is resources, and a lot of that was oil and gas in particular. And then we're looking at the forecast for next year, and so for the fourth quarter, and we're seeing that same type of pattern within most of those. So technology improves a little bit in terms of the forecasts. Manufacturing goes from losing money to making money, and so that's probably where there's some sort of scope for downgrades, we think. And then looking through the defensives, for example, have got quite a lot of earnings growth sort of built into that, and so same with consumers. So they're probably the areas we'd say are most at risk for Q4 earnings to see some downgrades. If I look through the companies that we did see the biggest downgrades for now, so about a third of companies we saw some pretty meaningful downgrades. So 13% of companies we saw earnings down more than 10%, and at 18% of companies we saw down somewhere between 3 and 10%. So healthcare and financials were some of the big ones. Transport was definitely one of the ones who you saw some of the biggest downgrades. So companies like Maersk in terms of shipping, and some of the trucking companies in the US, Knight Swift and C.H. Robinson, saw some pretty meaningful downgrades to 2024 earnings. UPS as well. So there's certainly on that front we're well and truly into the period of big downgrades, and that's probably going to keep flowing for a while within that sector. But given a lot of their earnings, we sort of ran through it a podcast recently on this, where it's a sector I'm interested in when we think we're getting close to the bottom, because that's probably one of the sectors that will turn around earlier. But for the moment, we're still seeing the downgrades because a lot of even though the sort of spot rates have stopped falling, these companies, a lot of them had locked in higher prices with their customers. And so as the higher prices are rolling off, they're rolling off to levels that are half or a quarter of sometimes of what the rate was they used to be getting from some of these customers. Semiconductors are really mixed, and this whole tech, the tech manufacturing side. So there's a number of really big names that we saw some really meaningful downgrades. So Cisco today, ON Semiconductors, ASML, which is ASML's like the makes the chips that makes the machines that makes the machines, so to speak, and they're sort of one of the one of the key upstream providers in terms of the ones that provide the when they're sort of at the start of the CapEx cycle. So when they're actually out there and expanding a lot, you know that there's more coming down the line. And then AMD saw some pretty meaningful downgrades as well. But on the flip side, there's a bunch of other companies that we saw upgrades to in those in that same semis. Things like Nvidia and Intel saw some reasonable upgrades. So in terms of upgrades, we saw roughly about half as many companies with big upgrades as what we saw big downgrades. So 6% of companies upgrading by more than 10%, and 13% by between 3 and 10%. So you're sort of talking, just under 20% of companies with meaningful upgrades versus about a third of companies with meaningful downgrades. Lots of oil and gas companies we saw upgrades. Having said that, a lot of that was around, I guess, the oil price spike that we saw as the war broke out in Israel, and so that's probably going to come back. It will probably see some more downgrades coming out of that, or certainly in the most recent weeks we have started to see a lot of those downgrades, and those the prior upgrades starting to reverse. The other interesting one is that there was a lot of sort of what I'd call loss-making or expensive tech, where we saw some pretty good upgrades in terms of the numbers. So I'll go through a bunch of different names: DraftKings, GoDaddy, Block, DoorDash, SoftBank, Shopify, Splunk, Live Nation, Okta, Datadog, CrowdStrike. Most of those, they're sort of tech-based companies. They tend to be online. Some of them are, a lot of them sort of more consumer-facing or small business-facing, and they've either improved their profits or reduced their losses by quite a bit. Now, some of that, it's sort of an interesting question with some of those as to how positive that is, in that possibly some of that is because it's actually a lot harder to raise capital now. And so if you're the plan for some of these companies over the last couple of years has been, lose money trying to gain market share and just keep spending to gain that market share, and then raise capital to whenever you start running out of money. Now, not being able to raise capital, arguably could be the case that a lot of these companies are now basically pulling back their spending because they know they're not going to be able to raise capital, or they won't be able to raise capital at a price they're willing to dilute themselves at, and so they're and so that's what's good for earnings. So that's sort of it's a little bit of a two-edged sword, that, for whether that's a positive sign for the market or it's more of a negative sign. And then the other one was quite interesting. A lot of the Japanese car makers, we've seen some reasonable upgrades. So Suzuki, Honda, Toyota all had quite reasonable upgrades within their forecasts. So we might go to the so that's sort of a quick summary of where we are in terms of reporting season. We might go to the question of the week, and then we'll talk about what that means for investment outlook.
Excellent. So now we've obviously got our question of the week. This is for viewers to have some discussion in the comment section over the coming days. Question for this week is, what sectors are most likely to meet 2024 expectations? So feel free to post your thoughts and engage with us and some of the other viewers over the coming days. And back to you, Damo, for investment implications.
Yeah, so as a big picture, the way we tend to try and invest within our active portfolios is we'll try and switch between quality and value stocks. So what I mean by that is we're happy to buy really high quality stocks at an average price or even a little bit above average, with a view that that'll carry them up, and they can even become quite expensive before we finally decide that no, it's too expensive and we need to tip it out. Whereas if we're going to buy an average quality stock, we need to buy it really cheaply. And then the view is, well, when an average quality stock goes up in price, then we sell it and we sort of move back into another cheap stock on that basis. And we do vary the amount of quality and value we'll have in our portfolio at any one point in time. So as we're getting through particular parts of the cycle, we'll load ourselves up on value stocks and say, okay, we think those value stocks do tend to perform well at sort of end of cycle sort of types of that sort of last sort of 25%, where companies are really starting, even sort of lower quality companies are really starting to expand their margins. And so we've been pulling back on that part of our market, and it's sort of more of we're starting to do more and more of that and clear more of those guys out as we get closer to this sort of what we think are going to be some pretty reasonable earnings downgrades. So the major themes which we're really looking for within the stocks we're buying is, one is sort of electrification type stocks. So companies that are benefiting from less so the green energy and the direct green energy and the direct people sort of making wind turbines and things like that, and more about the people providing the services. So basically the people plugging these things in and providing the engineering services to change electrical grids. And so we've got a number of stocks that we've got within our portfolio that's sort of chasing that theme. The obesity drugs one we've spoken about over the last little bit. So it's about trying to find stocks which we think are going to benefit from that, and then also the other side of that is underweight stocks which we think will lose out as these obesity drugs gain in the number of people in which they're treating. The whole onshoring and robotics side, so more manufacturing transferring out of China, the whole Build Back Better in the US and companies that are benefiting from that. And again, it's sometimes it's the companies, the manufacturers involved, but we're actually sort of prefer to be some of the service companies that are involved in actually setting up these new factories, and the companies that are doing that sort of work to automation and robotics and those types of things. AI is certainly well within our looking at both positively and negatively, and which stocks to be chasing there. Cloud computing is another big theme, where continued trend of just people, more and more companies just moving out of their own premises and onto the cloud, and the benefits we're seeing there. We think there's a gas price gap between Europe and the US. So in terms of gas in Europe is in a sort of $10 to $15 range or higher, and in the US it's more like $2 or $3. And so there's a lot of LNG coming on, and so we do think there's going to be some convergence in terms of that. And then quality stocks that we think can hold on to these sort of greedflation price rises, stocks that are more have more pricing power, and as we start to see pressure on prices, that will they'll manage to hold on to them. And on the flip side, stocks we're looking to avoid, well, one of them is the opposite of those, stocks that are just going to have to give back the margins. And so people like car makers and things like that have picked up these great margins but are going to give them back. Stocks that we do think China's into this terminal decline, and so stocks, we want to be avoiding stocks that leverage China. And then there's a whole theme around driverless cars and electric vehicles that's making some pretty reasonable impacts around stocks that we're looking to make sure we're avoiding companies that are going to lose from that trend. But yes, that's about it.
Excellent. So I just want to add on that, Damo, as the viewers are likely aware, we've got the screens and the tilts, and particularly with this episode today, we do have two tilts I want to highlight. So there's a large tech tilt, so you can add in extra exposure to large tech. So that's particularly the Magnificent Seven. So there are those stocks there. And we also have a cloud computing tilt, which is sort of interlinked or tied into those large tech stocks as well. So you can add them into any of our portfolios or have them as a standalone portfolio as well. So that pretty much wraps us up for today. So thanks, Doma. Thanks for sharing your insights as usual. And we look forward to next week. Awesome. So we do welcome your feedback on this podcast, especially in regards to suggestions for future topics. If you do have any ideas, please drop it in the comment section below or send us an email at contact@nucleuswealth.com. Also, if you know of anyone that might get some value out of today's episode, we'd really appreciate it if you do share it with them. So for myself, Damien, and the rest of the team at Nucleus Wealth, thanks for watching, and we look forward to seeing you next time. Bye for now.